Let's imagine for a second that I lost every dollar I've ever invested. Gone, wiped out. And I had to start completely from scratch. But I still remember everything I've learned along the way. So if that happened in 2025 or in 2026, and I had to rebuild my entire portfolio from the ground up, there are only 3 ETFs I'd put my money into. Just 3. These are the ones I'd trust to rebuild wealth, retire comfortably, and honestly, still sleep well at night. In this video, I'll walk you through exactly why these ETFs make sense right now, how I'd split them up, and what kind of returns you can realistically expect. All in plain English, no finance degree required. And as always, a quick disclaimer that this video is for educational purposes only. Always do your own research before making any decisions. Alright, enough setup. Let's skip the theory and jump straight into ETF number 1. ETF number 1, VOO, the core foundation. Alright, so let's start with the backbone of my portfolio, the one ETF that I'd build everything else around, VOO. The Vanguard S&P 500 ETF. This is what I like to call a set-it-and-forget-it investment. Because when you buy VOO, you're basically buying a tiny piece of the 500 biggest companies that drive the US economy. Think Apple, Microsoft, Amazon, Google, and hundreds of others quietly making America run every single day. And here's why this ETF is such a powerhouse. Over the long term, the S&P 500 has averaged around 10 to 11% annual returns for decades. That's through wars, recessions, inflation spikes, you name it. And when you factor in how easy it is to own, it's honestly tough to beat. Then there's the expense ratio, which is just 0.03%. That's $3 per $10,000 invested per year. You probably spend more than that on a coffee. It's one of the cheapest ways to own hundreds of world-class businesses all at once. And diversification, you're already covered. You've got exposure to tech, healthcare, energy, finance, consumer goods, basically every corner of the US economy. So even if one sector is having a bad year, another one's usually picking up the slack. Now, a lot of people ask, okay, but what about 2025 and beyond? The market feels uncertain. Is this still a good bet? And my answer is absolutely. US corporations are sitting on record levels of cash, profit margins are still high. Even if inflation hangs around 3 to 4%, these companies have historically grown their earnings faster than that, which means your money keeps its purchasing power and keeps compounding. If you're comparing, there are a couple of close cousins out there, SPY, which is basically the same thing but with a slightly higher fee, and SPLG, which tracks the same index but has a lower share price. So if you're starting small, SPLG can be a nice alternative. Now, as for how I'd invest into VOO, instead of throwing all your money in at once, I'd spread it out using something called dollar cost averaging. Basically, it just means you invest a set amount of money on a regular schedule, maybe every week or every month, no matter what the market's doing. Sometimes you'll buy when prices are high, sometimes when they're low, but over time, it averages out. It takes all the guesswork and emotion out of the process. You're not trying to time the perfect dip. You're building your position piece by piece and letting time and compounding do the hard work for you. And here's the mindset part. When the news is screaming recession or market crash, that's not the time to hit pause. That's actually when you quietly keep buying, because that's when long-term investors build wealth, one automatic deposit at a time. Oh, and before we get to the next one, as always, make sure to hit the like button if you're enjoying the video. And don't forget, subscribe to the channel if you want more videos like this. Okay then, let's get to the next one. ETF number 2, SCHD, the stability anchor. Alright, so if VOO is the growth engine of the portfolio, then SCHD is the stability anchor. This one adds that income and quality layer that keeps everything balanced, the kind of ETF that doesn't just grow your wealth, but also pays you along the way. Here's what makes SCHD special. It focuses on large, profitable US companies with long track records of paying and, more importantly, growing their dividends. We're talking about solid household names like PepsiCo, Coca-Cola, Texas Instruments, and Cisco. These aren't hype stocks. These are companies that quietly make money year after year through all kinds of market conditions. Now, in 2025, SCHD's dividend yield is sitting around 3.7 to 4%, which is a really healthy level. That's consistent cash flow that can either go straight into your pocket or be reinvested to buy more shares. And with an expense ratio of just 0.06%, it's still incredibly cheap to own. But what really sets SCHD apart is how it chooses the companies inside it. A lot of high-yield ETFs out there chase big dividend payouts, but that can backfire because those high yields sometimes come from companies that are struggling. SCHD does it differently. It screens for quality, strong balance sheets, steady cash flow, and manageable debt. In other words, it looks for companies that can actually afford to keep paying you through thick and thin. And here's why that matters for 2025 and beyond. We're probably heading into a world where interest rates stay higher for longer. That means investors will naturally lean toward reliable, cash-producing companies. And that's exactly where SCHD shines. Even if the market goes sideways or gets choppy, those dividend checks keep rolling in. You're getting paid while you wait for prices to recover. Here's a little bonus tip too. If you hold SCHD in a tax-advantaged account, like an IRA or a Roth IRA, those dividends compound tax-deferred. So every time a dividend gets paid, it buys more shares, and those shares start paying their own dividends. That's the snowball effect in action. Now, quick reality check. Dividends aren't free money. They're just a portion of the company's after-tax profits being shared with shareholders. But the beauty is in the consistency. For anyone looking for income stability, lower volatility, and steady growth, SCHD hits that sweet spot almost perfectly. So, while VOO is the growth engine, SCHD is like the shock absorber, keeping things smooth when markets get bumpy. ETF number 3. Triple Q, the growth accelerator. All right, so we've got our foundation with VOO, our stability anchor with SCHD, and now it's time for a little firepower. Triple Q, the NASDAQ 100 ETF. This is the innovation play. It gives you exposure to the 100 largest non-financial companies on the NASDAQ, basically the future of the global economy in one fund. We're talking about the heavy hitters here: Apple, Nvidia, Meta, Tesla, and Microsoft. These are the companies that are shaping how we work, communicate, and even think. Here's why Triple Q deserves a spot. The companies in Triple Q aren't just flashy, they're efficient. They have some of the highest returns on capital anywhere, meaning they take every dollar invested and turn it into profit faster than almost anyone else. Now, Triple Q's expense ratio sits at 0.2%, a bit higher than VOO or SCHD, but still way cheaper than most actively managed funds trying, and usually failing, to beat it. And the track record speaks for itself. Over the last 15 years, Triple Q has delivered roughly 14 to 15% annualized returns, even when you include the dot-com crash. And here's a crazy stat. If you had bought Triple Q right before the 2000 tech bubble burst and just held onto it, you'd still be sitting on really strong returns today. That's the power of long-term compounding in action. Of course, higher growth always comes with higher risk. Triple Q can take some big hits during market downturns. That's the trade-off. But here's the thing. Those pullbacks are where disciplined investors quietly build their biggest gains. If you're dollar cost averaging, you're automatically buying more when prices are low and smoothing out the ride over time. So, how should you use Triple Q? I'd make it a smaller slice of the overall portfolio, maybe around 20 to 25% if you want that higher upside. If you're younger and have time on your side, you can lean in a little more. But if you're nearing retirement, it's smart to keep it lighter and let SCHD and VOO carry more of the weight. And now that we've covered growth, stability, and diversification, let's talk about how I'd actually split this up, and what kind of compounding you can expect over time. Allocation and compounding. Alright, so now that we've covered the 3 ETFs, VOO for broad market growth, SCHD for income and stability, and Triple Q for innovation and upside, let's talk about how I'd actually split them up if I were starting fresh in 2025 or 2026. If I had to build from zero, I'd probably go with something like 60% VOO, 25% SCHD, and 15% Triple Q. That mix gives you a rock-solid foundation of diversification, a steady stream of dividend income, and just enough exposure to high-growth sectors to keep your portfolio moving faster than inflation. Now, obviously this can shift depending on your age and goals. If you're in your 20s or 30s and can handle a bit more volatility, you might tilt heavier toward Triple Q, say 20 or even 25%. But if you're closer to retirement, you might want SCHD doing more of the heavy lifting for that consistent cash flow. The key idea here isn't to chase what's hot, it's to build something that works quietly in the background, where the compounding happens automatically over time. Because here's the truth. Wealth doesn't come from guessing the next big stock. It comes from owning great businesses, staying invested, and letting time do the heavy lifting. If you stick with this mix, keep dollar cost averaging, and reinvest your dividends, you're setting yourself up for serious compounding power. It's not flashy, but some years down the road, that's when you realize how powerful it really is. If I had to start from scratch right now, I'd do it with just 3 ETFs. Forget the noise, all those lists telling you to buy 50 plus tickers to build wealth. That's just spreading yourself thin and hoping something sticks. Just 3 ETFs and one clear plan. That's it. Simple, focused, and effective. No guessing, no overcomplicating, no Wall Street advisor whispering in your ear. Just a strategy you understand, patience to stick with it, and ETFs that quietly do the heavy lifting for you year after year. Want to see how I'd take it even further? How to actually build the perfect retirement portfolio step by step? Check out the next video, where I break down exactly which funds I use and why. Thanks for watching. Keep investing, stay consistent, and let time do the work.